GKFX Prime presents the week ahead. Hi everyone. In England, we like to say that some people like to over-egg the pudding. And I have to admit, I might be one of those people. It's a saying that means to go too far in exaggerating. Okay, Rich, what are you talking about puddings for when there are trades to place? Okay, so what I'm saying is I'm aware sometimes I'll over-egg the pudding. But I think we might be on the cusp of a massive movement for the euro currency, and I'll explain why in just a minute. And by the way, I'd love to hear if you have any similar sayings. You can drop a comment on the video and I'll make sure to give it a thumbs up and comment back. First, let's dig into the key events in this week's economic calendar. Actually, I think it's fair to say it's a slow week for economic data, so traders will probably take their cues from elsewhere. Things like US-China relations, coronavirus vaccine trials, and whether the latest US stimulus bill can pass in the Senate. A quick reminder, it's Memorial Day and UK Spring Bank holiday on Monday, so US and UK stock bond markets will be closed. For the rest of the week, I've highlighted consumer confidence because ultimately, how quickly we recover from this economic downturn will depend on people's confidence to start spending again. Now, before I talk about this big moment for the euro, can I ask that if you're trading the euro and other markets, and you're glad I've made this video, please click that like button. It really helps spread the word for these videos. Okay, so in case you missed it, German Chancellor Angela Merkel and French President Emmanuel Macron agreed on a plan for a €500 billion EU recovery fund. Now, that's a lot of money, but it's not the amount of money that matters here. What matters is that the European Union, as an entity by itself, will raise the money by issuing bonds. This has never happened before, guys. It was attempted in 2011 during the Eurozone debt crisis, but politicians couldn't agree. So in the end, the ECB and Mario Draghi's whatever it takes line saved the day. Here's the thing. It has always been that European nation states by themselves have to borrow money for their own uses. Now, ask yourself this. As an investor, do you accept the same interest rate from Italy, which has massive debt and slow growth, as you do Germany, the strongest economy in Europe? Of course not. You need higher interest rates for investing in Italy than you do Germany to compensate you for the higher risk. The difference between the yield of Italian bonds versus German bonds is a big deal for the euro currency. It's called the Italian-German spread. What it gives you is a measure of risk of investing in Europe. Now, when it's a euro bond or whatever it gets called in the end, the risk of your investment is spread across all of Europe. So that's the crux of it. And why this could be a massive deal investing in Europe? If this fund were to happen, it might be seen by investors as less risky, meaning more investment could happen, which would increase demand for euros to make those investments. Now, notice I used the if word there. That's the thing, it still needs to be agreed by all 27 member states of Europe, and that will be an uphill struggle. And I suspect news around its support or lack thereof could be a key driver for currency pairs like the euro dollar, the euro yen and the euro pound moving forward. Okay, right, enough from me. Good luck with trading this week and make sure to subscribe so you don't miss our next video.